All right, well, you take it away. It's all yours. Oh, and
All right.
also for
Yes.
everyone, so sorry to cut you off. If anyone has a question, feel free to throw it in the chat. If it can get answered in the moment, Julie's going to do her best to, kind of field those questions, and I'll let her know. But if there, is a lot to cover and it's kind of a out there question, I'll log it, and then towards the end, I'll have kind of a question queue that we'll field to Julie in that way. But other than that, I'm going to mute myself, and Julie, you take it away.
All right, let's go. Welcome, everyone. Happy to have you. Today, we are talking about creating a compensation model that won't break the bank. We're talking about pay. We are talking about benefits. And if you've ever wondered, am I paying too much or how do I compete and still keep margins? You're in the right spot. We are going to address that question today. So I am Julie Harris. Hello, nice to see you. I am the CEO of GreenOak Accounting. We're an accounting firm that works with hundreds of private practice owners across the United States. I also host the Therapy for Your Money podcast, and I'm the author of Profit First for Therapists that you can see behind my shoulder over here. So that is me in a nutshell. I'm an accountant. I'm a lover of numbers. I am not an attorney. A lot of these topics are going to be attorney adjacent, so it's always a good idea to talk to an attorney or an HR professional to confirm the rules in your specific state. Just as a friendly reminder, attending this presentation does not create an accounting relationship with me. I'm providing this information for educational purposes. My hope here is that you can take some of this information and then go have a very productive conversation with your accountant, with your attorney, with your HR pro on what the options are and what you can do for your specific situation. But only you know what are your own facts and circumstances. That's the term that we use in accounting. And so those are really important context when it comes to making some of these decisions. So this presentation today is for those who are maybe thinking about hiring, right? We do tend to, it's always a great time to have that conversation before you've made your first hire on what can I afford, what should I do? But this is definitely going to apply to a small group, medium group, scaling group, right? So if you have really, if at any size of or phase of scaling, there are some of these challenges that you're going to face. Generally speaking, when you get to the 50 plus clinicians, you figured a lot of these pieces out, right? So this may not be as relevant to you, but if you're in that phase where you're still kind of like, this doesn't feel quite right, or I want to add this, but I'm not sure, then this is definitely the right presentation for you. So I'm going to start with just a quick question. I don't have a Zoom poll for this, but I want to ask everyone so I can kind of try to keep my attention on the areas that are going to be most relevant to you. So what is your biggest challenge around hiring and compensation right now? So if you can just put it in the chat, is it how much you can afford to pay, competing with other practices? Is it your comp model, or is it adding benefits? So what is on your minds? Okay, so I'm seeing D. I don't have a lot of answers yet. So this is the time, folks. In um in the Hoova app, I did see a lot of benefits related, C and D, A and D. Okay, okay. So we are going to spend some time there. Perfect. Thanks for sharing that. All right. Today's plan is we're going to talk about how much you can afford. We're going to talk about 5 common compensation models. Not that there aren't more than that, but we're going to talk about the 5 most common ones, how compensation evolves as your practice grows, how things change. We're going to have a very super brief 1099 versus W-2. We're going to touch on state rules and then benefit roadmap. So what to add, what order, how to do that. Okay. So one of the big questions I get is how much can I afford? What can I actually afford to pay? And these are my compensation recommendations, what we recommend to our clients at GreenOak Accounting. When you have someone who is fully licensed, they should be paid somewhere between 45 and 60% of the income they generate. That includes, however, wages, payroll tax, and benefits. This trips a lot of people up, so I'm going to say it twice. 45 to 60% includes wages, payroll tax, and benefits. All of those things included should equal somewhere between 45 and 60%. Now, to be realistic, if you have an insurance practice, you're going to be typically closer to that 60%. However, if you are a cash practice, it's not uncommon to be closer to that 45%, right? So somewhere within that range you should be good to go. But if you go beyond that range, you're going to see in the next slide what happens. For someone who is pre-licensed, so provisionally licensed, 35 to 45% of the income generated. So that also includes wages, payroll tax, and benefits. It is going to be less because A, they are typically less productive. B, their retention is going to be much lower. C, we want to have something for them to look forward to when they do get fully licensed. And D, supervision, right? There's a lot more case consultation. You or someone in your practice is going to be a lot more active in them doing their jobs, and we have to account for that somewhere, right? So they have to get paid less overall for that to make financial sense. All right. So why is my recommendation 60%, right? I get a lot of pushback on that. And a lot of people saying like, oh, that's not enough, Julie. It can't be done. Here's why, right? Really, when we're looking at that, that means 60% of every dollar that's coming in is going to your clinical labor. That leaves about 20% for overhead and 20% for profit. And I do stand firm on we should always be aiming for a 20% profit because 20 turns into 14 real quick when something bad happens, right? And so if our profit margins are razor thin, it really takes almost nothing for that to become zero. So we're always aiming for that 20. And sometimes it's going to be a little bit more, but also sometimes when things happen, it's going to be a little bit less and it's going to average out, right? But if we're not doing that, if our clinical labor is at 80%, that means there's essentially zero wiggle room for profit. And that's not a good place to be. It's actually a very dangerous place for a practice to be because that means there is no profit. There's no ability to create an emergency fund. It's very difficult to pay the owner, right? There's a ton of risk and no financial reward. And so that's part of the why. That is really important. And the truth is, if you're paying someone 60%, 60 isn't really 60%, right? If you're paying a 60% commission, just to use an example, once you add payroll taxes to that, that's already 64.8%, right? So you see how you've just blown past that right away. And that is before benefits. So if we're going one step further and adding benefits to that, which is often not going to happen at the very, very beginning, right? Not with the very first hire, but as we add more hires, typically I hear, okay, now I'm ready to add benefits, or my clinicians are asking for benefits. So if you add benefits on top of that, that's going to really quickly get you to 70%, right? And so because of that, that means that realistically, a fully licensed clinician often needs to be paid somewhere in the 50 to 55% as far as their gross wage, so that it leaves wiggle room for the other things, right? For payroll taxes and benefits. If we're going much higher than that, it's really difficult for that to actually stay within the 60%. And so when that doesn't happen, what we also will often see is owners working really, really, really hard to essentially subsidize the compensation of their clinicians. And I just don't think that's healthy for anyone. And so we've got to leave some wiggle room. And so, yes, there have been plenty of instances in the last 5 years where an owner has told me, like, well, the practices around town is offering, 70%, should I match them? And I'm not responsible for the practice around town, but I do know that that is unsustainable and they cannot financially sustain that long term. So that practice is either going to have to make some really hard decisions in a pretty short order, or they eventually will go under, right? So those are typically the only two options. There is not a way to make 70% comp work long term. There just is not. Okay, so let's talk about the most common compensation models that we are going to see in private practice. So we have percentage, we have a flat fee per session, we have hourly, base plus commission. So I saw that mentioned in the chat. And then we have salary. So let's go over each one in a little bit more detail. I do want to mention there is no universal best model, right? I don't have a magic wand that can tell you like this is the one that always works all the time. Each one has trade-offs and risks, and I'm going to show you what those are. And there are also sometimes stages where something works best. There are some sometimes state-specific reasons to do one or the other. But so ultimately, you are the owner of the business, and you are the only one who can decide what is the best thing for your business. But ideally, you're doing that with your advisors and with a lot of information in hand. Okay, and so when we look at a commission or a percentage, that is typically where you are going to pay a specific percentage of every dollar that the clinician generates in the practice, right? So let's say $1,000 comes in, you're paying the clinician 50%, and that means they're going to get $500, right? They're getting a percentage of the revenue generated. Typically, that means the percentage stays the same regardless of the reimbursement. So you might have a high reimbursement, a low reimbursement. That's all going to get averaged out, and they just get a percentage of all of that, right? All the dollars that are coming in. Typically, there's going to be a separate administrative rate for things like team meetings, but not for notes, right? When you're paying a commission, that is typically including the note time, the scheduling time, right? All the things kind of related to that session. But if you are requiring the team member to come in for a 1 hour meeting once a month, you're typically going to pay them an administrative rate for that. Now, this is often the most common starting point for a brand new group practice. Very often we see that. So this is essentially how it works, right? If you had a $150 fee, a 50% split, that means the clinician is keeping 75%. You'll see me use all kinds of different reimbursement rates in my examples. That's just because there is no one reimbursement rate that works for everyone, right? So you'll see me use a variety of things. So in this example, clinician gets $75 as their gross pay plus payroll tax and benefits. Practice keeps 75% of the gross, but of that will be deducted payroll tax, benefits, overhead, rent, right? All the things that $75 is not like $75 in the practice owner's pocket. It is what remains to pay for the expenses of the practice, which are numerous. There's a lot of different expenses that come up with a practice. So one of the reasons this is a very common compensation model for an early practice is because the risk is somewhat low, right? If the practice doesn't get paid, the clinician doesn't get paid, right? So it's low risk for the practice. However, if there is an increase in your reimbursement, which we're not seeing a lot of right now, your clinician is getting an automatic raise, right? And so the part of the risk in this situation is that even if you were to get a higher reimbursement, your clinician's automatically making more. They're often going to come to you asking for a raise in the form of a higher percentage, right? And so that's where we can see a profit margin start to erode over time as well. And so the other challenging piece here is that there is a ramp up period for new clinicians, right? Someone might start and they only have a handful of clients, so they're just not getting paid a whole lot. It might take some time for the billing as well. So the a percentage or commission does not eliminate the need to follow minimum wage requirements. So minimum wage always does apply. However, that would typically look like an advance, right? So you would pay the clinician at least minimum wage if insurance hasn't paid, for example, and then at a certain point when insurance comes, payments come in, you would true that up. Um, Josh, I see a handful of people off of on camera, so I wonder if we have questions at this point.
Yeah, we've got a couple questions.
Okay.
Jill had one question. It says, our money guy says we are paying too much, but are we?
Okay.
That's probably
Yeah,
pretty general,
that's
but that
tricky.
was just me saying what I was looking for out of today's session.
Got it. Okay.
Yeah,
Perfect.
cool.
Perfect.
And
Okay.
then we've got Sarah saying, I'm considering base salary and comp. I'm finding that comp is so much about the optics the clinicians have.
Yeah.
And then she also followed up with a different kind of question. What is a common admin rate?
Yeah. Most often we're going to see an admin rate somewhere between 20 and $30 per hour. So middle of that would be $25 an hour. It really is going to depend. There's some regional differences there, but usually it's going to be somewhere in that range. And usually often there's going to be a cap there. All right, let's keep going then. Our next common compensation model is flat fee per session. So this is where your clinician is paid a set dollar amount per session or per session that actually happened. Sometimes this can be an easier way to control margin in the sense that if your reimbursements go up, then the the dollar amount, the flat fee per session doesn't necessarily go up at the same time, right? You can choose to increase that rate. It can be helpful with when you have a mix of payers at different rates, in the sense that you can have like, this is your one rate, so the clinician always knows what they're going to get paid for every session, right? There's a lot of visibility there where I'll show you in the next slide. If you're seeing 10 sessions and your rate is X dollars, you're going to get paid 10 times X dollars, right? It can be a little bit risky if rates go down, which has not happened a lot, but we have seen a little bit of that this year. It also can be risky as far as timing. So this is typically paid when the service is rendered, in the sense that if the session is done this week and you run payroll next Monday, generally you're going to pay in that pay period, regardless of whether insurance has paid or not, right? So there are some times where a flat fee per session can be a little bit risky from a cash flow perspective. If there's a Change Healthcare situation or another kind of insurance hiccup, one of your big payers stops paying, like that can make cash flow really, really tight. That's not necessarily a long-term risk. That's just a short-term cash flow risk at that point. So as an example here, if your team member was getting a reimbursement or a flat fee of $70 per session, they're seeing 22 sessions a week, they would get paid $1,750 in gross pay, right? Plus payroll tax, plus benefits. This is not the net that they're taking home. This is not taking account the deductions or the withholdings that they have. This is just kind of their gross pay. Right. So disadvantage again here is if your practice has not been paid by insurance, this can be a little bit challenging. Risk profile of flat fee is fairly low. If insurance rates change, your costs don't change, so that can be good and bad, mostly good. If your payer mix were to change, it were to average to a lower rate, that could be a challenge as well. But that's kind of the exception more than the rule, right? Most often what we'll see is practices dropping the lowest payer, not leaning into the lowest payer, right? We're typically going in that direction more so. All right, our next comp model is hourly. This is going to be, as the name implies, you're paying for every hour worked. So there's typically a clinical rate and an administrative or non-billable rate. All hours get paid. So often this is going to come up. In a sense, flat fee and hourly are very similar, but hourly is typically going to come up in a state that requires practices to pay for every minute of work done, right? So if you need to track that and pay for all that, then this is how you're going to do it versus a flat fee per session. So you'll have two different rates, a clinical rate and an admin rate. All hours get paid. I do typically recommend a cap for the admin time. Even though if someone will work 10 hours over the cap, you still are required legally to pay it, but then you have a policy where you can go back and say, hey, you went above the hours, and so there can be disciplinary action at that point, right? That's what you would need to do. Ultimately, you still have to pay the hours worked. So looking at an example here, I'm using a very different rate. If we had a $40 per clinical hour rate for the clinical time and a 20-hour admin rate, if a clinician were doing 20 clinical hours and 5 admin hours for a total of 25 hours in the week, they would get paid $900, right? So you kind of see how that works. In this case, often the clinical rate is going to be significantly lower because we have to account for the admin hours, right? So when we're thinking about the total compensation for this clinician needs to equal less than 60% when we include their wages, their admin time, their payroll tax, their benefits. That means that we've got to reduce ultimately that clinical wage so that we can account for the administrative time that we are required to pay at this point, right? So this is the situation where it would work best. It is fairly it's fairly low risk. I'm calling it a medium risk here in the sense that there is definitely opportunity for runaway admin time. That's most often what we see, where well, we thought they were going to have, 4 hours of admin time per week, and all of a sudden it's 14, right? That can really bubble up costs pretty quickly if there's a productivity drift where that admin time is just kind of increasing over time. There's also just a compliance complication, right? This is definitely, it's just going to take more administrative time to double check the hours, and you need timesheets, right? And so it's just going to be a little more work on the administrative side, and that can be just a little bit less desirable for that reason. All right, next we have our base plus commission. So this is where we have a smaller guaranteed base that can either be an hourly base or a salary, although we're most often going to see an hourly rate, just from a simplicity standpoint, right? Because we do have to account for overtime rules, and so typically the base a base salary might not be enough to get around that. And so where the additional pay is tied to productivity, right? So it could be an hourly rate plus a commission. That's most often what we're going to see. That is a great way to kind of have a shared risk where your clinician has a safety net where the hourly rate is paid at the time the service is rendered, and then the commission is paid at the time the money comes into the practice, right? So it can help when it comes to timing in that sense, where only part of the pay is done upfront, and then part of it is paid when the funds are received. And that can be really helpful from a timing perspective when we think about how expensive it is to hire and onboard a new clinician. And so there is, in that sense, a shared risk. And then ultimately, the more clients a clinician sees, like they financially participate in that as well. So that might look like a $20 hourly fee, and that could be both for clinical and administrative time, right? So typically, we're just going to have a single rate at that point. So if they were seeing 20 clinical hours, 5 administrative hours, that would be a base pay of $500. Plus, they might get a 30% commission, right? So the commission is going to be smaller here because we're, again, accounting for the base hourly, but it is a combination of both. That's ultimately how the base plus commission is going to work. So you can see how there's that $500 paid up front, the 30% commission when cash is collected, which for a cash pay practice, that's just not going to be a big deal because the cash is collected almost immediately. But for an insurance practice, like you're often just seeing that delay, right? If insurance pays, right away on time, like sometimes you're seeing that cash in 10 to 14 days. But if there's a denial or if something else happens, it can be significantly longer for you to see that money. And so risk profile here is going to be a medium. It often can be confusing to clinicians. I think it can work really well, but as someone mentioned in the chat, the optics really do matter here. And how it is explained to a clinician, the visibility they have over how this is working really it is important, because if the formula feels really confusing, there can be some mistrust. Also, like if we're kind of over promising, like, look, this is all the money that you're going to make, right? If in a perfect scenario, and that doesn't happen in those first couple of paychecks, that can be a little bit disconcerting for newer clinicians. So this does require a lot of clear communication and tracking so that the clinician is aware of what is going on. Now, actually, I'm going to go to salary before I talk about pay bands. But ultimately, in any of these compensation models, if a clinician does not understand how their pay is calculated, that is not a formula for success, right? There's likely going to be some resentment at some point or some mistrust where they come back and say, like, Josh, tell me how this was calculated. Like where did this number come from, right? And they're going to just ask questions in a really pointed way. So just the more clarity, the better ultimately. Our last option is going to be a salary model, and I put this last because this is probably my least favorite to see. I think a salary is very, um, um, can be very attractive to a team member and puts a lot of risk onto the practice. So in a salary situation, you would have a fixed annual amount. That might look like 70,000 per year, $80,000 per year, right? If you were working for a hospital system, that's what you would expect. Like you know in advance what your gross pay is going to be. This can work really well for a high producer when you know what to expect from someone, but can be really challenging to hire someone right off the street where you actually don't know what they're going to be able to do, what is going to be an acceptable caseload for them, what they're going to be able to do in a sustainable way, right? So ideally, you need predictability in both sides in the sense that you know what to expect from your clinician, but that you also have certainty that you are going to be able to get them full and keep them full, right? So if there are marketing systems that are maybe not working and you're not sure, that can be a riskier model. So let's look at an example of how this might be calculated. You might look at if a practice was charging $125 per session, you're estimating that at a minimum, your clinician is going to see 22 sessions per week, 48 weeks out of the year. That means they're generating about $132,000 for the practice in 1 year. So 50% base would be 66,000. To that, you would add payroll tax and benefits, right? So you'd still really quickly get to that 60% cap. And so that gives you a super, super high level of how we would calculate something like that. But what I tend to see very often, and that's why this is a highest risk profile for the practice, is the owner is most often putting on their rose-colored glasses when they're running this calculation and saying like, well, I know this clinician usually sees 23 clients a week, but I really want them to see 25. So I'm going to just assume that they're going to get there and stay there permanently. And so we're calculating based on like ideal situation. And really the best predictor of future performance is past performance. If we know someone is typically around 22, 23 sessions per week, we should count on that continuing to be the case, right? Like we should not count on a salary permanently changing their behavior. That's typically not what happens. Because so one of the reasons that this is so high risk is that if the sessions dip, if you're not getting paid by insurance, if you don't have any clients for this clinician, you are legally required to pay them their full salary, right? You cannot deduct or or dock their pay unless they're taking, paid time off or something like that. Like you must pay them their full salary. And so what happens with a salary is that you must be willing to correct underperformance immediately. If someone is not meeting their clinical expectations, you have to be willing to engage early and often so that it doesn't get out of control. Also, hiring someone who is salaried is very expensive upfront, right? You are paying them their full salary for weeks while they are not necessarily performing, right? While they are ramping up. And so that doesn't mean that it's impossible, but it typically means that if you are hiring folks on a salary basis, you are going to have to hire slower because you want to get them all the way full before you hire again, right? Because that's really expensive in those first couple of weeks. All right. So
Julia, I'll jump in real quick. There's a
yeah,
really good question from
yeah.
Stephanie. She said, I thought the recommendation was to not go above 50% all in, like benefits, taxes, etc. And she says, here it looks like you're saying 60%. She's wondering if she's wrong about the 50%. And if she is, how is there a profit margin with 60% short of having a really lean practice with other expenses?
Yeah. Yeah, so so I'm not sure where you heard 50%, Stephanie, but I've worked with therapists for the last 10 years, and my general recommendation for most of those 10 years has been your clinician compensation should be somewhere between 45 and 60% all in of your revenue, right? 45 to 60%. And so that means and maybe you've heard like 50% base pay. So in that number, I include wages, payroll tax, and benefits. So all of those. If you're talking about 50% base with payroll tax and benefits, you're really already at 60%. So maybe we're just talking about kind of two different perspectives of essentially the same thing. So when you do that, that leaves about 20% for overhead, 20% for profit. So yeah, that does require a lean overhead. And that means if you are able to get that number to 55%, then do you have more room for overhead and profit? Yeah, yes, you do. But so always in accounting, there's always to every action, there's an equal and opposite reaction, right? So if you're spending money here, that means you can't spend it there. And so those are just part of the thousands of choices that you have to make ultimately as a business owner. And only you know what's right for your practice, right? So I have some of our clients tell me, I'm going to spend more than 60%. I need 63%, but I'm willing to be really, really lean here. I'm going to use my space. I'm going to get the least expensive space I can. I'm going to use it so efficiently. Like I'm willing to do that because I want to spend more here. Okay, it's your business. You choose. You can choose that that's what you want to do, right? But you just can't have all of those things. You can't go high in everything and expect to still have a profit margin. Yeah. All right. Shall we keep going? All right. So I wanted to take a second here. Now that we've talked about the five compensation models, you'll notice I did not talk about, um, you know, doing a base percentage and for this many sessions to this many sessions and another percentage for that many sessions to that many sessions. It still I still see it quite frequently, but I find that it's challenging to explain to clinicians. It's challenging to run payroll with that. I don't think it's ideal, and I think it rarely changes long-term behavior. And so that's why I didn't even mention that in the presentation, just because I don't think that's where you need to start when you are growing your practice. I do want to take a second to talk about how compensation evolves as your practice grows. And really my perspective, and I've said this a lot this year, I believe that as the CEO, as the owner, your number one job is to protect the practice. So you are responsible for the survival of the practice, and you can't make decisions that are great for one single person, but put the entire business at risk, right? You must protect the practice. And that doesn't mean that your client is not the most important thing, right? But I think protecting the practice is ultimately in service to the client. We must make sure that the practice survives next week, next month, next year, and that requires financial sustainability, right? If you are running a practice at a loss, there is eventually an end point to that where you no longer have room on your credit cards, you no longer have personal cash, no bank will lend to you, right? There's not like this magic pile of money that's coming to save you. And so we have to run ultimately profitable businesses to make sure that they can survive. Okay. And so I just think that is your responsibility, and it is in service to your clients. It definitely is in service to your team, right? For the practice to survive, in service to your community as well. So, and that's where I come back to this often when we're making these really challenging compensation decisions of like, we can't make a decision that serves only one person, but not the practice ultimately, or that's going to be difficult. So that being said, there is no one correct compensation model that's going to work with everyone. Different practices have different numbers, different reimbursement rates, different risk tolerance. So the right model for you is one that your practice can sustain and that is going to serve you long term. And as I mentioned just a couple minutes ago, your compensation decision really is about trade-offs, right? So there's no magic formula. It's like if you go high here, you have to go low there. Or if you go really high in comp, maybe you can't afford a lot of benefits, right? So like there's all these trade-offs that must be done. And I wish I could tell you, if you pay 52.3%, like everything's going to be okay. And that's just, I don't think running a business is that simple, right? It really depends on what is going to work for your practice. Some common mistakes that we see, like in the early hiring, almost always that first clinician is paid way too much. Almost always, 90% of the time. So try to kind of lower your expectations. It comes from a real place of generosity, but it also comes from a place of not considering all the other expenses that are related to scaling a practice. Copying someone else's comp, right? Like, oh, I asked in a Facebook group how much they're paying, and that's what I decided. Often the question that was not asked is, are you making any money with that compensation model, right? Like sometimes the comp model, yeah, like it works, but they're not making any money. Also in that early startup phase, contractors treated as employees, highly, highly dangerous at the state level, at the federal level. Like if you have contractors, there's not a lot of control that you can have over what they do. In that middle stage, kind of growing, just a handful of clinicians. Common mistakes are adding leadership before the practice can actually afford it, adding benefits without running the numbers, without knowing if it's financially possible, or complex compensation formulas that no one understands. And in that larger, 10, 11 plus person practice, giving raises for people who are not meeting their clinical expectations, hiring more clinicians instead of holding team members accountable, right? Thinking like, oh, if I just hire someone else, it will fix the problem. Or sometimes also adding too much leadership or administrative staff, just because the whole thing feels overwhelming, or we're not holding people accountable. Some red flags that it's time to kind of rethink your compensation model. If every time you're running payroll, you are nervous, like, is there going to be enough money in the bank account? Can we actually make it? It's probably time to look, like, take just a good hard look at your numbers and see what's going on. If you can't imagine how you would ever be able to afford benefits, if you feel resentful to your team, if your clinicians don't understand how they get paid, if you are giving raises but you're barely paying yourself, that's big red flag. If you're making less than some of your clinicians, like, it's time to just relook at the whole system to make sure that it is still serving you, and make some changes. And of course, like, making compensation changes are always very challenging, but next month is always going to be even harder than this month, right? Best time to plant a tree is 20 years ago. Next best time is today, right? We cannot go back in time. Like, we can deal with today, the Chinese proverb. So before you change your comp, like, I really want you to think, can the practice still pay its bills and still pay the owner, you? Is it sustainable if you hit a rough patch, or an insurance panel challenge? And will it be simple enough for my clinicians to understand and trust? Ken asked me to talk about raises, and I barely have any time for it. But when it comes to raises, there's just quick 2-minute version. Um, you've got to give yourself room for raises, right? If you're starting at the tippy top of what you can pay, there is no room for raises, and people are just going to ask for that. So it's ideal if you can give yourself some room. Um, don't give raises to people who are not meeting their clinical expectations. Like, if they're already not doing what they're supposed to, why are we paying them more? Um, if you're not getting increases in reimbursements, you have to be really careful with raises, right? You just have to. And I know you want to, and that's really generous, but, like, we still have to be financially careful. So do leave yourself some wiggle room, consider performance when you're doing raises, and have a clear method or process, like how often you're going to offer raises, based on what are the factors that you're looking at, so that you can be fair to your whole team. Leadership models. When it comes to leadership compensation, highest risk is going to be moving someone to salary, just because you have to pay that no matter what. Lowest risk is going to be offering a fixed stipend, right? So you've got a couple of different options. I will upload these slides to Hoova, and so you will have access to them, but I want to make sure that we get to benefits quickly here. So 1099 versus W-2. I wanted to give you, like, the 1 or 2 minute version of this, just because it comes up often in those early stages. Often it feels easier to hire a contractor, but really a contractor or a 1099 needs to be independent. You cannot offer benefits to a contractor. Do not. They really should be sending you invoices. There's no payroll tax, but there's also no control, right? You cannot control the what, when, where, how. And so really, most clinicians really should be employees, which are W-2. So when you have a W-2, you control what work is done, how it's done, where it's done, when. You are required to withhold payroll tax and remit that, right? So there are some complexities to it, but really, a 1099 is higher risk, W-2 is lower risk, because you won't get in trouble for hiring a W-2 as long as you do things correctly, but you might get in trouble for hiring a 1099, right? So not to say, like, I've seen plenty of practice owners get in big trouble for not paying their payroll taxes, right? So I'm not saying that you can never, but if you're doing things correctly and using a payroll service, W-2 is very reliable. All right. Let's move on to a 1 minute on state rules, and then we're going to go straight to benefits, because I want to make sure that we have time for questions. Okay, so when it comes to state level rules, this is where it is important typically to have an attorney or an HR pro that is intimately familiar with your state, county, city, right? Sometimes there are things at the county and city level as well. So as far as an attorney goes, like you do want to work with someone who is local so that they can help you see around the corner. And I wish there was one big repository of here's all the rules for everyone everywhere. There is no such thing, right? There are very few rules at the federal level. Federal level, there are no rules on paid time off, paid holidays, any of that. Not they're it's the Wild West essentially, but there are a lot of state level rules. And so you do want to be familiar with what is required in your state, city, county. Some states have mandatory sick time and or paid time off. Sometimes they're the same, sometimes they're separate. Some states have paid family leave requirements where you are required to pay that is typically going to be a payroll deduction, but you do need to be aware of that. Some states are going to require that you have a retirement plan based on the number of employees that you have. And in some states, it is one single employee other than the owner. Isn't that crazy? And so that doesn't mean that you're forced to contribute to the retirement plan, but it means that you are forced to facilitate the retirement plan. So you must allow your team members to participate, and you have to remit the funds if they decide to withhold any. So there's just a lot of different requirements that you may or may not be aware of. Some states are going to have pay frequency rules, like how often you're required to pay, final paycheck timing. So you just want to know like what is the requirement for you. I am putting a link in the chat. I am a big fan of Gusto. I think they're the best payroll company out there. And they have a great guide, whether you use Gusto or not, they have a great guide on state requirements. Excuse me. So I want you to have that available. Okay. So this is really an area where I want you to know what are the must-haves in your state. Also, if you're considering hiring in a new state, I want you to know what the requirements are there. Give me Okay, I'm back with a little. Right. Can you hear me okay, Josh?
I can hear you. Yeah.
Okay, I'm losing my voice over here. Benefits. So, benefits that clinicians are going to care about is going to depend on the size of your team and the age of your team. This is the order in which we most often see benefits added. Most often, we're going to see continuing ed credits first, then paid time off and sick time, retirement plans, health, disability, and then sometimes additional stipends. The order in which you offer these are going to depend on your state requirements, right? Sometimes you're going to have to go straight to PTO because that is the state requirement. If that's the case, that's where you should start, right? But I want to go over each one of these just to make sure that you have kind of an idea of what the costs are going to be. If you're offering a CEU reimbursement, that often means that the clinician is going to pay for that upfront and then submit a reimbursement to you. You typically are going to have a fixed dollar amount that you're going to offer for that. You might say like up to $250, up to $500, right? You get to decide what it is, but I would have a clear cap on what the annual limit is. And so you can do that. This is where it really is a low budget item because you decide exactly what it's going to be. And you have full control of that, right? So you usually are just going to have a spreadsheet and decide like if someone goes over the limit, you're not going to reimburse beyond that. Okay. So you have full control of the dollar amount. When it comes to paid time off and sick time, when possible, you should pay at the admin rate just because it's going to balloon really quickly. But some states are going to require you to pay at a clinical rate or a blended rate. And so you want to know again from your HR professional, what is the requirement in my state? So when you are offering that, you want to also bake that into your hourly percentage, your salary, right? Like whatever compensation model you are choosing, you want to consider the paid time off that you are going to pay because that's going to further reduce your hourly rate. right? And so you want to have a sense of like, what is the compensation once we add all of these things in, because it can go up really quickly. And my general recommendation when you are offering paid time off, you should have a policy on how many people can be out of office at once, right? There usually is going to be an approval policy. Unless you are closing the office for a certain period of time during the year, you usually can't have everyone out at the exact same time, right? Or everyone at a specific location out at the exact same time. That's going to create some real big cash flow challenges. And so you do want to have control over that. And so a good policy will get you around that. I'm not saying like, you know, you're going to deny Susie's, visit to her great aunt's funeral, right? That's not what we're saying. But like when we're talking about planned items, like we generally want to have some policies around that you can work on with your HR professional. When it comes to retirement, often when you have kind of more seasoned team members, like the more full-timers you have, they're often going to value this or want this is more, at the closer to retirement they are, also the more they're going to value that. You're typically not required by state or federal law, actually you're not, to match. That is not a requirement. You might want to offer a match. Some plans like, and you are going to have flexibility on which plan you choose. Some plans are going to require a match. But you, when it comes to adding this as a benefit, often you are going to add a match just because that's part of the benefit that the employees are looking for. Administrative costs are often modest. You can get a tax credit for setting up a retirement plan. But you do want to run the numbers ahead of time so that you know what it's going to cost, right? When we're running the numbers on this, I usually plan on what if everyone does participate in the plan, what would it cost? Typically, not everyone will, but you want to make sure that it's affordable even if everyone is going to participate. Typical matches are usually going to be somewhere between 2 and 4%. And so that gives you an idea of how much that's going to cost. When it comes to health benefits, these are often going to come up not because like an owner is really excited about offering this, but because more like as they're recruiting, more and more clinicians are asking for them, right? To retain full-time clinicians, often they're going to be looking for that. But I generally recommend ask your team members what they want, right? Ask them what is important to them because based on the age of your team, the demographics, like they might not care for health benefits or they might really, really need it, right? So you can start where it's important for your team. In a traditional group health, you typically need at least 2 team members to participate to be able to get a group health for your group. The practice will typically pay 50% of the employee's premium, but the cost for that is going to vary wildly based again on the age of your team. So if you have team members that are 50 plus years old, like that can easily be $1,000 a month premium, which means that it costs your practice, $500-600 a month. Whereas if your team is younger, that can be a pretty inexpensive benefit. The other risk here is that premiums can jump significantly, as you all know, from year to year. And so that, what you thought was a cost that you could afford becomes an unaffordable cost in a future year. The nice thing though here is that you can exclude part-time team members. You can and you should typically, right? If someone is not full-time, they should not be on your plan. And that's usually not your decision, it's the plan docs that are going to determine that. There are some options, some alternatives here in a QSERA or an ICRA. Those are reimbursement plans where the team member has their own health insurance plan and gets reimbursed for that plan through a QSERA or an ICRA. That is great as far as controlling the dollar amount that you can spend, right? You can say you get a reimbursement up to $350 a month. So there's a cap. However, I must say, as nice as I think those are for controlling costs, it is often less valued by team members than a traditional group coverage. A lot of times, team members who are not, they're not business owners, they're going to come to you and say, I need insurance from my employer, right? They're not necessarily knowledgeable about how to go out and get that on their own. And so like the perception again is important here, and we just want to consider that. So risk for health benefits is high in the sense that group premiums can go up really hard, really high. It is difficult to roll back. Once you've got this, it's hard to not offer it anymore. And so when prices go up, you're just kind of stuck with them. Disability, life insurance, FSA, there's other nice to have add-ons. They're typically fairly inexpensive. They're typically added after all of these other items have been added. And they are low cost, but they're also low value to the team members, right? So they're kind of nice to haves. No one's saying like, oh, I don't want this, but this is also not what they're asking for typically at the very beginning, right? And so these are items that you can add later on. The costs are going to, again, vary wildly depending on the age and health of your team members. Sometimes they can be a benefit offered that is employee paid. Sometimes you're going to pay for it as the employer. So just consider costs when you're looking at that. All right. When it comes to benefits, that's typically going to be about as much as payroll tax. So anywhere between 0 and 8%, depending on if you have benefits or not. So just consider like when you're looking at your gross wage, you're adding 10 to 15% on top of wages between payroll tax and benefits. And so that's why we really have to consider that cost. It is significant. I think we are getting to our Q&A. No, I was wrong. I have one more just example of benefits. So PTO as an example, if you're offering 5 days, 40 hours at $25 administrative rate, that's $1,000 a year. If you're having to use a blended rate, you're 10 days at $50 an hour, that's $4,000 a year, right? Big, big, big difference. So what is the state requirement? What can you do? How many hours are you offering? Like you want to be really mindful of that before you go in and offer it because you don't want to have to roll it back. Um, uh, Retirement plan, if you were doing a 3% match, that for someone making about 75K a year, that would be 2,250, right? So like just run the numbers either on your own with your accountant, run some projections, get in that Excel or Google sheet, and get an idea of what that is going to look like. All right. On that note, let's go to some questions.
Yes, Sarah asked a question about handling a shift in the comp model. She said, we're flat fee and it's not working, so she's looking for your advice.
Yeah. Okay. So, Sarah, communication is where I would start. I do think you need to over communicate. So I would show team members a side by side, but tell me, what are you going to?
I am exploring the base plus commission. So I
Okay.
would say, to be honest, actually, I'm trying to decide from what you've presented today. They know, and I just had a team meeting last night. They know that the comp model right now isn't really working for us.
Okay.
So I've already kind of set the stage for that. I haven't provided any numbers, but we have annual reviews coming up, so I feel like that's yeah, a part of it too.
Okay. And are you going down in comp basically?
I'm trying to balance out our comp because I think people are having a hard time with the idea of like meetings with their supervisor, things like that, where they feel like they should be paid for those hours, even though they're like kind of wrapped in with their commission.
Yeah.
And so I think,
Yeah.
yeah, I'm trying to manage the optics and also go down so that there's room. I know it sounds strange, but like so that there's room in the future to be able to adjust because people are
Yeah.
asking for raises and we're like right at the top that we can
And you're
do.
right at the top. Yeah.
Yeah.
Okay. So when it comes to change management, I always plan on not everyone's going to be happy with this, and we might have some people who leave, and that has to be okay, right? Because if we go back to like your number one job is to ensure the survival of the practice, this is in service of that. And so sometimes that doesn't happen, but I'd rather like you be prepared. Like maybe some people are going to not be happy, and I'm going to have to stand firm, and this is what's best for us. I would over prepare and have also something visual for them to see, right? So I would say like, here's how you're currently getting paid and what that looks like, right? You're doing this and you're doing this hour of supervision or whatever that those things may be. And now you're going to do those and like, here's how you're going to get paid for all of those. And here's what it's going to look like at the end. Because it's probably going to be similar or a little bit less, but like I want them to understand what the change is and why, right? I think that is really important. And I think it's okay to say like what we're doing right now is simply unsustainable for the practice. And so that's part of why changes have to be made, right? And it doesn't have to go into a detail of like and I don't know anything about your situation, right? But like I'm just kind of over exaggerating. Like I'm gonna have to take a second mortgage on my house, and like like it's just no, not that level of detail, but like there's no margin in this business. It is a risky industry that we are in. We cannot continue at this rate. And you're unhappy because you feel like you're not getting paid for these. So we're going to change the system where you're getting paid for all of this. And that also means like you're going to get paid less for your clinical work. And that's because you're getting paid for those things. I'm going to post a link in the chat. This is a podcast episode that is about a transition from 1099 to W-2 with one of our longtime clients. And although that's not what you're doing, I think the way the change management was done was really, really good. So I do encourage you to listen in on like kind of she also talked a lot about um the emotional, like preparing for the emotions of the clinicians, like during this transition. And as an accountant, that's not something that I'm mentally prepared to do. But I thought that was just a really good kind of like, obviously, you're very qualified for that. So I think it's a good perspective on it. I would encourage you to listen into that.
Thank you.
Yeah, you're welcome.
We've got about 4 more questions, so maybe if we
Okay.
can fly through this.
Yep.
I know we don't have a
I'm
whole
gonna
lot of
power
time.
through.
So yeah, Jayon said, if using a commission/split model, do clinicians have to be paid for collateral contacts, i.e. phone call with client psychiatrist?
Um, Typically, no. So what, from a legal perspective, what we are up against is minimum wage laws, right? And so when we think about the commission that a clinician would get paid for their time, like if we were looking at all the time they spend in your practice, that's typically going to be significantly above minimum wage. Where you do have to check though is like, what does your employment agreement say, right? This is a time where we consult with the attorney and say like, have we clearly specified that all of these things are included in that commission, right? The scheduling, rescheduling, the touch points, like that's what we want to do. So we want to build an employment agreement that includes those things, and also double check with our attorney that that's legal where you are. Yeah.
Well, then we're wondering here, how do you manage healthcare/benefits when people fluctuate between part-time and full-time numbers?
Yeah, typically that's going to be an audit. You're like you personally are going to do an audit of your team members. I would probably require like have a requirement. You must be full time for X months before you qualify for benefits. And then if you drop below full-time hours for X months, then you will be dropped from benefits, right? It really goes back to the policies and enforcing those policies. And really, if you were audited by your health plan and they were not eligible, but they're still on your plan, that would be a problem for you. So it's really protecting the practice again, but just having strong policies around that and not just saying, like, well, it's not their fault, or yeah, like we just have to be firm on those, unfortunately. Because it's not a question of like us being nice, it's a question of the integrity of the policy.
And how do you handle late cancellations and no-shows? How do you determine what the admin cap should be? Kind of maybe two questions in one there.
Yeah. The no-shows are going to be always challenging, right? We're going to try to minimize those. I want your clinician to be incentivized to get them rescheduled quickly, right? And so it kind of depends, like, are you charging a late cancellation fee? If that's the case, like typically they're getting a percentage of that as well. If they're not charging anything, like, 50% of zero is zero. And so like you want to have your own policies around that, but typically having a cap is going to be like, okay, well, then use this hour as one of your administrative hours this week, right? If you are paying admin time, you would take that into consideration. You wouldn't necessarily pay more unless there was a reason to do it because your practice is not getting paid.
Yeah, and then we got one more. Jesse's asking if we wanted to increase the clinical staff's hourly rate and we were borrowing that increase from the owner's pay, which is acceptable to the owner, is that something you would typically support an owner doing?
I would say proceed with extreme caution, right? I would say like if you've got a 30% profit margin, you're saying I'm okay with going to 28, sure. Okay, great. But if you're at 18% and you're saying I'm okay with 15, I think that can be like you might feel okay with that, but then when you are someday maybe wanting to sell your practice, like that's going to really be a problem, right? Where your profitability is really low. That means your valuation is going to be significantly lower. I also think it's really easy to erode that even more over time. And so I'd just be really, really, really careful. Like without knowing your specifics, I'm going to say no, I would not support that. But there may be some cases, some fringe cases where I could.
Well, that's everyone. We flew through
Okay,
that pretty well. You answered
we got
those.
it. We did it. All
My
right.
opinion is you did great. So who knows?
Amazing. I love rapid fire questions. I'm going to hang out for another minute or two if you have a question. My team works with practice owners across the country. Here's a link in case you are interested in scheduling a consultation to low pressure just to see if you might if we might be a good fit for you. Please feel free to do that. No pressure at all. So thanks for joining us today. Thanks, Josh, for um,
Doing
managing
what I do, right?
the
Whatever it is.
questions, doing all the things that you do. Yeah. Any last minute questions before we hop off? All right. Thanks everyone for attending today. Have a great conference. Take care.